Hi, our topic for today is an overview of your accounting. And under your overview of accounting, we will learn the following items. First, of course, we need to define accounting. So we'll learn later the definition of accounting. Next, we will talk about the accounting process. And after we go with your accounting process, we also talk about your different business organization as to form and type. Also, we will talk about your branches of accounting and the generally accepted accounting principles in the Philippines. Generally accepted accounting principles in the Philippines. And of course, lastly, we will talk about your different accounting concepts. So that's it for our overview of accounting. So those are the topics that we will learn today or we will discuss today. So let's start. We start first with the definition of accounting. So accounting is defined in different ways. However, we will only discuss three important definitions of accounting in accordance with different organizations. So first definition is the definition provided by ASC. ASC is known as your Accounting Standards Council. Okay. Now, accounting is defined in your ASC as a service activity. It is a service activity. So the question is, why is accounting a service activity according to your Accounting Standards Council? Because it is a service because it provides quantitative information, primarily financial in nature, about economic entities that is intended in making useful decisions. Okay. So here in the definition of your Accounting Standards Council, we have here a service activity. Why? We have here a function of accounting in which you have a quantitative info. So let's say this is your quantitative info. This quantitative info, take note, is purely financial in nature. And this financial in nature quantitative info helps users. So this helps users to make economic decisions. Okay. So what happens in the definition of your ASC is they look into the function of your accounting. So from your accounting, what happens? We have a financial info, and that financial info is used for decision making. So it is a service activity, especially to users, for them to understand properly the business organization through the financial info. Okay, so that's the first definition of accounting. Next, we go to the second definition of accounting provided by AICPA. AICPA, or your American Institute of Certified Public Accountants. Okay, so under your AICPA, it is defined that your accounting is an art. Accounting is an art. So why is accounting an art under your AICPA? Accounting is an art because it follows a process it follows the art of recording, classifying, and summarizing. Recording, classifying, and summarizing. Recording, classifying, and summarizing. So AICPA defined accounting as an art. It is the art of recording, classifying, and summarizing. So this, again, will be used to interpret the results of your financial events. So generally, what happens in your AICPA definition is that we follow a step. We have a step that is, first we record. After we record, we classify. And then after classifying, we summarize. And take note, what we will record, classify, and summarize again are your transactions and events which pertain to financial character, again, of course, and you interpret the results of this art. So a while back, we defined ASC. The definition provided for accounting under ASC is that it is a service activity. So why is it service activity? It helps user to make accounting or make economic decisions. Under AICPA, it is an art because we have here your step of recording, your classifying, and summarizing. It is an art because based on those steps, you try to interpret the results. It is an art because you try to interpret the results, just like any other abstract art or any other art that is made by an artist. So after finishing your main product, you try to interpret it. So that is the use of the definition under AICPA. We have here the different steps. Until then you finish it, you try to interpret it. That's why AICPA provided this definition of accounting. So ASC, service activity. AICPA, it is an art. The third definition in which we will most likely to use and we will expound more is definition provided by AAA. So what is AAA? It is known as your American Accounting Association. American Accounting Association. So your AAA defined accounting as a process. It is the process of identifying, recording, and communicating economic information that is useful in making economic decisions. Okay, so again, we will use or we will expound more on the definition of your AAA as to accounting. And AAA defined accounting as a process of identifying, recording, and communicating economic information that is useful in making economic decisions. Okay, so why do we use this definition instead of the other definitions? Because AAA definition outlines accounting and the use of accounting. It outlines accounting and the use of accounting. Why does it outlines accounting and the use of accounting? It outlines accounting in the sense that it shows you the accounting cycle. And what is that accounting cycle? That is the process of identifying, recording, and communicating economic information. So that will be our accounting cycle. So later on, we will discuss what are the items of your accounting cycle, and you will see that it is part of identifying, this is part of recording, and this is part of communicating. And then another is the use of accounting, because accounting or the results of information or results of this process is used to make economic decisions. It's used to make economic decisions. So take note, we have here a process And through this process, whatever is the output of this process is used in making economic decisions. Okay. So your main question here is, who will make the economic decisions? Who will make the economic decisions? So take note, the persons who will make the economic decisions are your users, And who are these users? So these are the users of financial information. And these users can be known as your primary users and other users. So we can categorize them as either primary users or other users. Okay. So who are your primary users? So we only have two primary users, and these are your debtors or creditors. Next are your owners, stockholders, or investors. Okay. So who is a debtor or a creditor? A debtor or a creditor is a person who has a claim over the entity. So, for example, we have here A and B. Now, si A umutang kay B. Si A umutang kay B. Sabihin natin na 10,000. Ayan. So, sino si A at sino si B? Si A ay yung debtor mo. Si B ay yung creditor mo. Okay? So, sino yung debtor? Siya yung may utang. Sino yung creditor? Siya yung nagpautang. Siya yung may claim. Okay? So here, we more emphasize of a creditor. We more emphasize it as a creditor. Okay? We more emphasize more on your creditor as to your primary users. Okay, so I hope you understood who is a creditor and who is a debtor. Next, we go to another primary user. That is your owners, stockholders, or investors. So who are your owners, stockholders, or investors? So your owners are the owners of the business. Owner of the business. Next, we have your stockholder. When we say you are a stockholder, this applies in a corporation. And you are a stockholder if you own at least one share. So what is that share? So a corporation generally issues shares of stocks. So it is known as shares or stocks. So if ever you purchase one share of a corporation, you can be a stockholder. Investor is the same as your owners or your stockholders. So a person who invested over the business, that is mainly your owners or your stockholders. Now, guys, why are these items, or why are your debtors, creditors, owners, stockholders, and investors considered as your primary users? Okay, so your primary users are your creditors or your owners, stockholders, or investors. And the question now is, what difference does it make between your primary users and other users, and why do we classify them as such? So the answer here goes with your basic accounting equation. Your basic accounting equation is equal to your asset is equal to your equity. Asset is equal to your equity. So what do we mean by your asset is equal to your equity? Your asset, these are your resources. came from your equity, came from your equity. What do we mean by equity? We mean ownership. We mean ownership. So your asset is equal to your equity, and your equity is composed of two items. That is your equity of your creditors and your equity of the owners. Okay, so that's why when you try to see or find in your textbook, you will read that your accounting equation is equal to your asset is equal to your liabilities plus owner's equity. So what is your equity of creditors? That is your liability. These are the claims of your creditors over the entity. How about your equity of owners? These are your owner's equity. These are the claims of your owners, stockholders, or your investors over the entity. Therefore, to answer the question, why are your creditors, owners, stockholders, or investors consider the primary users in your business? That is because your assets came from your creditors and your owners, or your financial resources came from those. And without them, you don't have any resource to use in the business. Okay, your financial resources came from your creditors, owners, stockholders, or investors, and without them, you don't have any resource to run the business. Okay, so we have this again. We now try to discuss the primary users and other users, and in discussing that, we learn about this basic accounting equation. And this basic accounting equation is your asset is equal to your equity, and your equity represents ownership. Your equity can be broken down into two: your equity of creditors and your equity of owners. Equity of creditors represents liability. Equity of owners represents owner's equity. Therefore, taken together, we have this basic accounting equation. Asset is equal to your liabilities plus owner's equity. That's the reason why you have that basic accounting equation, and that's also the reason why your creditors and your owners are considered as your primary users. Okay, so we're done discussing the second portion of the definition of our American Accounting Association, and that is the making of economic decisions by the users. And we said we have your users, primary and other users. Take note, if they are considered primary users, they are primary users. If there is a user not considered as primary user, then it means they are your other users. Other users. So I think before in your senior high, you learned about your users as whether they are within the entity or outside the entity, right? So if ever that is an employee, that is a user within the entity. If that is a government, that is a user outside the entity. But for our discussion, we consider our users as either primary or other users in the basis of your basic accounting equation, and soon you will learn that it is in the basis of your conceptual framework. Later, we will discuss what is a conceptual framework when we go through your generally accepted accounting principles. Okay, so we're done defining, we're done expounding this portion, useful in making economic decisions. So we go now to your process. So we said your accounting is a process of identifying, next, recording, and communicating financial information. So we start first with the process of identifying. So we start first with the process of identifying. So identifying is known as your analytical component. Analytical component. Why is it known as your analytical component? It is known as your analytical component because we are to analyze whether a transaction or event is accountable. Okay, so identifying is the analytical component because we analyze whether a transaction or event is accountable. So here we try to recognize accountable events. Okay, so we try to recognize accountable events. So how do we recognize an accountable event? We recognize an accountable event if ever it is first probable, next it is measurable, third it meets the definition. Okay, so we recognize an accountable event if it's probable, measurable, and meets the definition. So what do we mean by probable? It is probable that economic benefits will flow into the entity. So what do we mean with economic benefits flowing into the entity? So for example, if that is an asset, so kanina, di ba, meron tayong asset is equal to liabilities plus owner's equity. So for example, that is an asset. If ever an asset, there must be an economic benefit to the entity. So halimbawa, property. Yung property mo, as time passed by, we say it increases value. And the increase in value is considered an economic benefit. Okay, probable that economic benefits will flow to the entity. That's one portion. Flow to the entity. Flow to the entity. Another is it is probable that there is an outflow of economic benefits. Outflow of economic benefits. So whenever it is a flow to the entity, we consider that as an asset. If there is an outflow of economic benefit, we consider that as a liability or an expense. So when we say outflow of economic benefit, there will be a decrease of your assets. So for example, you have a liability. May utang ka, binayaran mo yung utang mo. That is an outflow of economic benefits. So, nabawasan kasi yung economic benefits mo or yung assets mo. Next, we go with your measurable. When we say measurable, it must be capable of assigning peso amounts. It must be capable of assigning peso amounts. Okay. So, it must be capable of assigning peso amounts. Okay, so if ever we are to measure capable of assigning peso amounts. Okay, so how do we measure? We measure by our functional currency, which is the Philippine peso. Philippine peso. So that is your measurable. Lastly, your meets the definition. This is a definition provided by your standards or your accounting standards. Later on, you will learn what are your accounting standards. Okay, so whenever we say it meets the definition based on your accounting standards. This is important because before you can say that an item is property, plant, and equipment. So, sir, what is a property, plant, and equipment? So, that can be your land, your machinery, your equipment, your buildings. Those are property, plants, and equipment. So, those property, plant, and equipment, let's say you are to recognize it. Before you can recognize that, it must meet the definition. So, what is the definition of a property, plant, and equipment in accordance with the standard? If the definition provided with the standard coincides the property, plant, and equipment that you are to measure, then you can recognize. So when we say, what are the criteria to recognize an accountable event, we have these three items. So this is your main recognition criteria. Okay, so it is known as your recognition criteria. Okay. So if ever, how do you recognize your answers are? First, it must be probable. Next, your answer must be, first, it is probable. Next, it is measurable. And lastly, it meets the definition. Okay, so that is for the recognition criteria in accordance with our old conceptual framework. So how about the recognition criteria with the new conceptual framework, or the conceptual framework 2018, which is just produced or published last 2018. So recognition criteria based on conceptual framework. Okay, so under your conceptual framework 2018, the following are your criteria. It must be relevant and it must be faithfully represented. So when we say relevant, it is capable of influencing decisions. Okay, it is capable of influencing decisions. When we say it is faithfully represented, that if ever you will present it in your financial information or as part of your financial statements, it must be properly presented in such a way that you do not omit anything, in such a way that you don't omit anything. So how do you recognize your standards? So we have the three, and under your 2018 conceptual framework, we have the two. It must be relevant and faithfully represented. But in the concept of your basic accounting, when can we say that the item should be part of our uh, transactions? Or when can we say that the item is really accountable? So we can say that the item is accountable, of course, if that pertains to the business. That pertains to the business. So we only account for transactions or events. So, di ba, ang tanong kasi dito sa identifying is the transaction and event accountable? Okay, that is the question. So we have here a transaction or event that affects the business. Question is the transaction or event accountable? So when can we say it is accountable? If it pertains to the business. If it pertains to the business. So there are three types of transactions. So the first one is a business transaction. So what is a business transaction? So these are your transactions recorded in the book. Transactions recorded in the book. Okay. So, sir, what is book here? Siyempre, baka kasi uh, yung mga non-APM for sure, medyo nagugulat sila. What is book? What are your transactions? So, whenever we see transactions or events, these are the different transactions per se. These are the different business or dealings made by the organization or the business itself. So these are transactions. When we say recorded in the book, we have here a journal. We call it a journal. Whenever we say book, we mean journal. So whenever we try to have an accountable event, we will record it in the book. So pag sinabing you record it in the book, you record it in the journal. So soon, when we go through our accounting cycle, you will learn that whenever we try to analyze information and after we say it is accountable, then we can already record it in the journal. Okay, so yan na. Business transactions are transactions recorded in the book. Take note, we only say that the transaction is accountable if it pertains to the business. And what do we call this transaction that pertains to the business? Business transactions. Another type of transaction is a personal transaction. So what is a personal transaction? So these are transactions not recorded in the book. This pertains to transactions of the owner himself, not to the business. Okay, so we have here a transaction. However, the transaction is for personal transaction or the owner himself and not to the business. I know you have researched this one. We have here your separate entity in which the business is separate to the owner. Therefore, if there are personal transactions of the owner, that will be not accountable. If that transaction pertains to the business, that is accountable. Take note, business transactions are accountable. Business transactions are accountable. And when can we say that it is accountable? You should properly measure it. It must be probable and it must meet the definition. Are we clear? And the third type of transaction is your neither business nor personal. Neither business nor personal. So these are other business transactions that are not accountable. Okay, so for example, the entity entered into a contract. So this is a transaction. Entity entered into a contract. So they will enter into a contract. Question, is that a business transaction? Yes. Next question, is it accountable? No. Why? Because although there is a probable economic benefit because of the contract, it is not measurable. It is not measurable. Why? You cannot assign any peso amount to it. May pera bang nakikita dyan? Wala. How about if the entity agreed into a contract? Same lang din, di ba? Same lang din. So we just really need to know the concept of an accountable event. When do we recognize it? And is it a business transaction or a personal transaction? Take note, business transaction recorded, personal transaction not recorded. How about if neither business nor personal not recorded? Why? Because it is not an accountable event based on our recognition criteria. Okay, so again, we use your recognition criteria to say that the item is accountable event. Okay, so that is for our accountable event. Okay, so your accountable events or your events can either be an external event or an internal event. So what is an external event? So this involves the entity, business entity, and an external party. Okay? This involves the business entity and the external party. If that is an internal event, it only involves the business entity. It only involves the business entity. Therefore, there is no external party in an internal event. Okay, so events can either be external event or internal event. External event if involves external party. Internal event if it does not involve external party. So what are your external events? So the first external event is your exchange or reciprocal transfer. Okay, so what is this exchange or reciprocal transfer? So there will be an exchange between the business entity and external party. So for example, ito si business entity, ito si external party. Tapos sabi ni business entity, magbebenta ko sa'yo ng isang cellphone. So I will sell one cell phone. In return, you will pay me 20,000 pesos. Okay, so there is an exchange. The business entity will give cell phone to external party. External party will give the business entity 20,000. So that is an exchange or reciprocal transfer. So there is a person who is giving and at the same time receiving. So business entity gives one cell phone and receives 20,000. External party gives 20,000 and will receive one cell phone. That is an exchange or reciprocal transfer. The second type of external event is your non-reciprocal transfer. Non-reciprocal transfer, it means that it is only a one-way transaction. One-way transaction. So for example, business entity, external party, business entity will donate one cell phone to the external party. So the donation here is a non-reciprocal transfer because, of course, when you donate something, you don't intend to receive something in return. Okay? So generally, if ever you try to donate, whatever you give, you don't expect that you will receive something. Okay? So that is a non-reciprocal transfer. Third one, we have your external event other than transfer. Okay, external event other than transfer. So this is an event which involves changes in your resources or obligations caused by external party but does not involve transfers of resources or obligations. So business entity, external party. So there is an external event caused by your external party. However, there is no change as to there is no transfer in between them. There is no transfer in between. So for example, business entity and external party works in the same industry. Works in the same industry. So let's say your external party is bankrupt. Your external party is bankrupt. Because of the bankruptcy of your external party, your merchandise inventory or those goods for resale, the market value increase. The market value increase. So the book value as compared to your market value, there is an increase because of the bankruptcy of your external party. So there is an external event caused by your external party. However, there is no transfer. But that external event affects your business entity in that way because there is an increase on the market value of your different assets. That is the triggering event. Okay, so here there is no transfer. However, there is an accountable event pertaining to the business entity. Okay, so that is for our external event. It is composed of three types of events. First, you have your exchange, non-reciprocal transfer, and your external event other than transfer. We go now to your internal event. In an internal event, take note, it is only your business entity. There is no external party. And in your internal event, it is composed of events which, again, do not involve external parties. So examples are production. So what is a production? So let's say you are into a manufacturing process. So how does your manufacturing process works? From your raw materials, you manufacture it, manufacture to create a finished product. Okay, to create a finished product. So that is your manufacturing. So as you can see, you purchase the raw materials. The manufacture happened inside the entity. So it is all your business entity. That's why production is considered an internal event. So guys, even if it's an internal event, we can still measure it because it is an accountable event, because it pertains to the business entity. It pertains to the business entity. Another example of your internal event are your casualties. Okay, so your casualties. So let's say it is a casualty caused entirely by the business entity, then that is an internal event. Just take note, internal event, no external party. External event, there is an external party. Okay, so we discussed your identifying in a way that you need to learn when can we say we identify an item, if ever it is an accountable event. And your event can either be external or internal. But then again, when can we say that the event is accountable? If ever it pertains to the business. And we go to your recognition criteria. It must be probable, measurable, and meets the definition. Also, we talk about your different business transactions. That can be your business transactions, personal transactions, neither business nor personal transactions. Further, we talk about the users of these economic decisions or users of this economic information to make economic decisions. We say we have your primary and other users. Primary and other users, okay? So that is for our identifying component. Okay. Next, we go with your recording. So recording is the process of capturing the information to the books. So from the accountable event, we place it to the books. Okay, so we have here your transaction and event. What's the first thing that you need to know? Question is whether that is an accountable event or not. If your answer is yes, then you record it. If your answer is no, do not record it. Okay, so when we say we record it, we record to the journal. Okay, in the recording again, we need to measure. We need to measure. What do we need to measure? The peso amount of the transaction or event. We need to measure the peso amount of the transaction or event. This measuring or placing peso amount of the transaction or event measuring is known as your technical component. Okay, so we measure your peso amounts. That is for your recording process. So for your recording, take note, your accountable events will be recorded to the books. Your books are your journals. So we stay first on that one, journal first. Soon we will learn that there are different types of books. There are different types of books. Lastly, we have your communicating. Lastly, we have your communicating. So again, it is the process of identifying, recording, and communicating. So we're already have a transaction or event. You said that it is an accountable event, therefore you record it. So these items on your record will be communicated. So from your record, it will be communicated. So when we say it will be communicated, it will be distributed to users of economic information. So your communicating is composed of two processes. First is your preparation of financial information, and then next is the distribution of financial information. So when we say preparation of financial information from your recording, we prepare financial information. And after it is prepared, you now distribute it. So when we say we distribute it to your users of economic information. By the way, communicating is known as the formal component. formal component. Okay, so we have three components: analytical, technical, and formal component. So your communicating is known as your formal component. We try now to prepare and distribute accounting reports to users of economic information. So how do we communicate? The question is, how do we communicate? So we communicate the financial information through the financial statements. Okay. We communicate the financial information through the financial statements. So we use your financial statements to communicate your financial information. And your financial statements is composed of the following items. First, we have your statement of financial position. This is also known as your balance sheet. Okay. Your statement of financial position shows your assets, liabilities, and your equity. Next is your statement of comprehensive income. Okay. Your statement of comprehensive income shows your income, expense, and other comprehensive income items. Okay. So your financial statements, first, we have your statement of financial position. Next, we have your statement of comprehensive income. Your statement of comprehensive income is composed of your income, expense, other comprehensive income items. Okay, your statement of comprehensive income can be presented in two other financial statements. First, you have your statement of financial performance. Okay, so for your statement of financial performance, we have only your income and expense. So this will give you your profit or loss. Okay, so income and expense will give you your profit or loss. So income less expense will give you profit or loss. Another item on your statement of comprehensive income, if ever we try to separate it, is the statement of other comprehensive income. A statement of other comprehensive income. So what are the items here? So first, you have your item of profit or loss, plus or minus the items of your other comprehensive income. Okay, so we have your items of profit or loss from your statement of financial performance, and then we add or deduct your other comprehensive income. Okay, so the question, or if ever you will ask, what are the other comprehensive income? So generally, the difference between these two, statement of financial performance and statement of other comprehensive income, is the presence of other comprehensive income items. So what are these other comprehensive income items? So our mnemonics here is cited. Cited. First, we have your surplus on revaluation. Next, we have your investments measured under fair value through other comprehensive income. Translation gains or losses on foreign financial statement. We have your employee benefits, actuarial gains or losses. Lastly, we have your derivatives, designated as cash flow hedge. Okay, so the items of your OCI. So again, in your statement of financial performance, we have your income or expense. And then in your other comprehensive income, we have your profit or loss from your statement of financial performance, plus the items of your other comprehensive income. So what are the items of other comprehensive income? Surplus on revaluation, investments measured under fair value through other comprehensive income as to your gains or losses, transactions gains or losses, employee benefits as actuarial gains or losses, derivatives designated as cash flow hedge. So as you can see, these items are again gains or losses. However, these gains or losses are not presented in profit or loss, but they are presented in your other comprehensive income. Okay, take note, these items are still gains or losses. However, they are not presented in your profit or loss, but presented in other comprehensive income. So pag nakakita kayo ng ang binigay is interest income. So wala naman siya sa OCI, di ba? Eh di dun siya sa profit or loss. Pero pag nakakita kayo ng gains or loss under FBT OCI, that means it is part of your other comprehensive income. Okay, so that is your statement of comprehensive income. We can break it down into two other statements. However, under our standards, we must only present one, that is your statement of comprehensive income. Next, we have your statement of cash flows. It reconciles your beginning cash plus or minus the cash transactions. We have your ending cash. Your cash transactions is broken down into three main activities. We have your operating, financing, or investing. When we say cash transaction, this must be cash inflow or cash outflow. Okay, so your statement of cash flows is composed of your beginning cash plus or minus your cash transactions. It will give you your ending cash. When we say cash transactions, that can be cash inflow or cash outflow. And these cash transactions are broken down into three different categories: operating, financing, and investing. So we're done discussing three types of financial statements. We have your statement of financial position, statement of comprehensive income, statement of cash flows. We go now to your fourth financial statement. So our fourth financial statement is your statement of changes in equity. Changes in equity. So in your statement of changes in equity, we have your beginning equity plus or minus your changes in equity. We have your ending equity. Okay, so this now reconciles your beginning equity together with your ending equity. So we have your beginning owner's equity, you have your changes in equity. These changes in your equity happens based on your profit or loss and your investments or withdrawals of your owners. Okay, so beginning equity plus or minus changes in equity. Take note, I just please your investments or withdrawals. However, soon you will learn that other changes on your equity is brought by your distributions to your owners, in the form of profit distribution or in the form of your dividends, in the form of your dividends for your corporation. Okay, so we have your beginning equity plus or minus the changes in equity is equal to your ending equity. Statement of changes in equity. Next, we have your notes to financial statement. Notes to financial statement. So these are your accompanying notes regarding your accounting procedures for the users to properly understand the financial statements. So accompanying notes for the users to properly understand the financial statements. Okay, so what are the financial statements that we learned today? We have 5: statement of financial position, statement of comprehensive income, statement of cash flows, statement of changes in equity, and notes to financial statements. What are the usage, or what is the use of these financial statements? Primarily to communicate the financial information of the business to the different users. Okay, so we're done discussing the whole definition of your accounting under your AAA. That is the process of identifying, recording, and communicating. Okay, so it is like a mini accounting cycle. It is like a mini accounting cycle wherein the financial information will be communicated through the process of identifying and recording. However, here we did not dwell much on what are the items of recording, but at least we learned that once we say it is accountable, we can record it. And finally, we try to prepare the financial information and communicate it to users. Okay, so that is the definition of our accounting. We go now to your different branches of accounting. Different branches of accounting. So we will only discuss few branches of accounting. First, we have your financial accounting. So what is your financial accounting? Financial accounting focuses on your general purpose financial statements. It focuses on your general purpose financial statements. It is concerned with the recording of transactions and preparation of financial statements. So recording of transactions and preparations of financial statements. That is your financial accounting. The second one is your management accounting. So under your management accounting, it focuses on your special purpose financial statements. Special purpose financial statements. It is intended for management use. It is intended for management use. That's why it's known as management accounting. While financial accounting is intended for all users, that's why it is financial accounting, because we look into your financial information and transactions, and later we prepare financial statements. Here in your management accounting, we have a financial statement, but the use is only for your management. Okay, so financial accounting, general use, management accounting for the use of the management. So what are the types of financial statements in a management accounting? You can have your budgets, reports. So these are your financial statements that your management accounting will try to make use. Third branch of accounting is your cost accounting. So in your cost accounting, we are to account for your cost of materials, labor, and overhead used in production. Okay, so generally, you only use cost accounting for manufacturing operations. You use cost accounting for manufacturing operations. A while back, we already said what are the items for manufacturing. What do we do in your manufacturing? So from raw materials, we convert them into finished goods. And generally, before you convert them into finished goods, you will incur this cost. What are those costs? Cost of materials, cost of labor, and cost of overhead. Fourth one, we have your auditing. Okay, so auditing is a systematic process of objectively obtaining and evaluating evidence regarding economic assertions and events, and ascertain their degree of correspondence between assertions and criteria. So generally, what we have here is we have a financial statement. So this financial statement, we ascertain the degree of correspondence of these assertions to the criteria. So what is the assertion? It is the financial statement. The assertion is the financial statement. And in auditing, we ascertain the degree of correspondence of this assertion to your criteria. So what is your criteria? Your criteria is the generally accepted accounting principles. So based on your financial statement, is it in consonance with our generally accepted accounting principles? If yes, if no, that is auditing. Okay? So we ascertain the degree of correspondence of the assertion to your established criteria. Next, number 5, we have your tax accounting. Of course, this dwells regarding your taxation. And normally, this is your tax returns and tax advice, and of course, tax accounting as a whole. Next, we have your government accounting. So this is the accounting of national government funds. Okay, so we have here 6 branches of accounting. We discuss financial accounting, management accounting, cost accounting, auditing, tax accounting, government accounting. Madali lang naman to, guys. Pagka may lumabas soon na tanong regarding tax, tax accounting yan. Cost of materials, cost accounting yan. Degree of correspondence, auditing yan. Okay, so it is easier for you to understand these branches of accounting based on their use. So financial is for general purpose, managerial is for your management use, cost accounting used for manufacturing operations, cost of materials, labor, and overhead. Auditing is used to ascertain the degree of correspondence between the financial statement and the criteria, which is your generally accepted accounting principle. Next, you have your tax accounting, which dwells more on your taxation, tax returns, tax preparations, and tax advice. Government accounting, more on your accounting of your national government funds. We go now to your business organizations. So what are your different business organizations? So a while back, I said that your business organizations is dependent on your form of the business organization and the type of your business organization. So as to form, we will only discuss the main 3 forms. We have your sole proprietorship, partnership, and corporation. Okay, so a sole proprietorship is composed of one owner known as the sole proprietor. Okay, one owner known as the sole proprietor. Partnership is the association of two or more persons known as partners. They are known as partners, and a corporation is an association of persons again. But remember now, your corporation can be a one-person corporation. One-person corporation. Okay, so before, your corporations must be at least 5 to 15 shareholders. Now, we have a one-person corporation in which you can create a corporation consisting of only one person. So if ever it is a corporation, it is known as shareholder. So the owners are known as shareholders. So sole proprietorship is composed of one owner, sole proprietor. Partnership, two or more persons known as partners. Corporation, one-person corporation, pwede na siya. So any holder of the shares of the corporation is known as your shareholders. Anyway, we have discussed a while back what is a shareholder. We go now to your business organization according to your type. So First one, we have your service business. Service business, this is engaged in the rendering of services. Rendering of services. So this can be your dentist, your nurses, etc. Barber shop, that can be a service business. Next, we have your merchandising business. Merchandising business. When it is a merchandising business, it is engaged in the buy and sell of goods. Okay, it is engaged in the buy and sell of goods. And last type is your manufacturing, which is engaged in the production of finished goods. Engaged in the production of finished goods. Okay, so take note, when we see production, from your raw materials up to conversion into your finished goods. Okay. Next, we talk about your, so we're done with 3 topics at least. We are done defining what is accounting. We also talk about your different branches of accounting, and we talked about your business organization. We go now to your generally accepted accounting principles. Generally accepted accounting principles. So what is your generally accepted accounting principles? So the generally accepted accounting principles refer to your rules, procedures, policies, and standards that is followed in the preparation and presentation of your financial statements. So these are rules, procedures, policies, and standards used in the preparation and presentation of your financial statements. So when we talk about your GAAP, the GAAP, or generally accepted accounting principle in the Philippines, the GAAP in the Philippines is collectively known as your PFRSS. PFRSS, or your Philippine Financial Reporting Standards. Okay, so GAAP are rules, procedures, policies, or standards. So what is the GAAP in the Philippines? It is known as your PFRSS, or your Philippine Financial Reporting Standards. Now, under Philippine Financial Reporting Standards, it is composed of 3 standards. So the first one is your PFRSS, or PFRS, which is your Philippine Financial Reporting Standard. The second one is PAS, or your Philippine Accounting Standard. Next, we have your PFRIC, PFRIC, Philippine Financial Reporting Interpretations. Okay, so it is known as your interpretations per se. Okay, so we have PFRSS, PAS, and PFRIC. So if ever you are asked, what is the accounting standard in the Philippines? Your answer is your PFRSS. And when you say PFRSS, it is PFRS, PAS, and PFRIC. Meaning, PFRSS is collectively the term for your 3 standards. So this term is, or these 3 standards is collectively known as PFRSS. They are collectively known as your PFRSS. And since they are known as your PFRSS, they have equal authority. They have equal authority. Okay, they have equal authority. That is for your PFRSS. And take note, what is the usage, or when to use the PFRS? You only use your PFRS. It apply to general purpose financial statement. So take note, a while back we said your financial accounting is for your presentation and preparation of financial statement. So how you present and prepare financial statement based on the GAAP. And when we say based on the GAAP, it is based on your PFRSS. And PFRSS are these three items, okay? Are these three items. So take note, PFRSS apply only to general purpose financial statement that is used in your financial accounting. That is used in your financial accounting. So that is the GAAP in the Philippines. That is the GAAP in the Philippines. Okay, so we're done discussing the accounting definition, and we said that is to provide information that is useful for economic decisions. Take note, if ever you are asked again soon, what is the purpose of accounting, you go with the definition that is to provide information useful in economic decisions. And also, we're done discussing the different branches of accounting, also the business organizations, and the GAAP in the Philippines. We go now to your basic accounting concepts. Basic accounting concepts. So our last topic for this morning is your basic accounting concepts. So we will try to elaborate the different accounting concepts and how will we use it in accounting or as we go through our discussion. So first, we have your entity concept. Entity concept, or it is also known as your separate entity or accounting entity. So what is this entity concept or your separate entity or accounting entity concept? That the business is separate from its owners. That the business is separate from its owners. So whatever is the transaction of the business is the transaction of the business. Whatever is the transaction of the owner is the transaction of the owner. We made clear about this one whenever when we talk about your accountable event. We said that if ever we account an event, it must only pertain to the business and not a personal transaction of the owner. Okay, so that is the entity concept. So for example, an owner purchased a gym equipment for himself to the money of the business. Will that be for the business or for the owner? So the gym equipment, of course, will be for the owner. It is not a transaction of the business. How about if ever the funds used by the owner of the business? You can consider that as a withdrawal. You can consider that as a withdrawal. Okay, so but take note, whoever benefits out of the transaction, that is the person or the entity who will record the transaction. So in that case, the gym equipment is not for the business, but for the personal use of the owner. Next accounting concept is the concept of your time period. Time period. This concept requires that the life of the business should be divided into time periods. So life of the business should be divided into time periods, and only transactions on a particular time period must be presented or accounted. Okay. So, for example, this is the life of the business. You try to divide it into different periods. So that can be, let's say, this is 1 year. So if you divided this one, we have a semi-annual life. So if ever we have a transaction during this period, you report it on this half year. So first half year. So yun yung ibig sabihin ng time period. So Kung dito nangyari yung transaction, dito mo siya i-present. Huwag dun sa pangalawa. Nasundan? So if ever hinahati-hati natin siya, tandaan lang kung kailan nangyari yung transaction. Kung nangyari during that period, doon mo i-record. Kung hindi nangyari during that period, huwag mong i-record doon. That is your time period. Your time periods can either be a month, a quarter, semi-annual, or annual. Of course, a month per month, a quarter composed of 3 months, semi-annual composed of 6 months, annual composed of 12 months. Okay, your annual periods can be a calendar year or a fiscal year. An annual period is known as a calendar year or a fiscal year. Okay, so if it is a calendar year, it starts from January to December. Kasi nga calendar. 12 months siya, pero January to December. Pag fiscal year naman, it is still 12 months, but not starting in January nor ending December. So for example, we have February to January. So February 2020 to January 2021. That is still 1 year. However, it is not a calendar year, but a fiscal year. Sir, annual periods, so this is known as your annual periods. If ever you are asked, what is an annual period? It is composed of 12 months. We also have your interim periods, not composed of 12 months. Okay, so what are these interim periods? This can either be a month, a quarter, or semi-annual. Why? They are not composed of 12 months. So if ever you try to divide the life, we have these time periods that can be interim periods or annual periods, and your annual periods can either be a calendar year or a fiscal year. It can be calendar year or a fiscal year. Okay, so that is the second concept, time period. Just take note, you record the transaction on the correct time period. Next, we have your monetary unit assumption. Monetary unit assumption. So when we say monetary unit assumption, your transactions are measured in terms of a currency. Transactions are measured in terms of currency. And our currency here in the Philippines is Philippine peso. And our currency in the Philippines is your Philippine peso. Your monetary units assumption is composed of two components. So the first component is the stability of peso. So what is this stability of peso? When we say stability of peso, we assume that the peso is stable. So any changes in peso is ignored. So assuming you have 50 pesos. So sabi natin, any changes in the peso is ignored. So kung 50 pesos yan, dati sabihin natin yung 50 pesos, pwedeng bumili ng isang sakong bigas. 1 sack of rice. Diba? But now, 1 peso, 50 pesos or 50 pesos can only purchase, let's say, a biscuit. Although not realistic. Let's say, yan yung mabibili ng 50 pesos. So before, 50 pesos, 1 sack of rice. Now, it is biscuit. Is there a change in the value of the peso? Yes. Before, the value of the peso is worth more. Now, the value of the peso is worth less. But do we account for the change? No. It will still be 50 pesos. It will still be 50 pesos. Hence, we can learn here, even if there is an inflation, even if there is a deflation, we do not account for it. because we assume that the peso is stable, meaning whatever is the value, that will be the value, because the changes are ignored. Any changes in peso are ignored. Next, we go with your quantifiability of peso. Quantifiability of peso. So when we say quantifiability of peso, they are quantified in the currency, quantified in currency of the Philippines. Okay, so kung 50 pesos yan, 50 pesos yung currency natin dun sa Pilipinas, so 50 pesos yun. Okay? Dito sa Pilipinas, edi 50 pesos yun. Okay? So you quantify it based on Philippine peso or our currency in the Philippines. So whatever is the value in peso. Value in peso. Okay? So monetary unit, transactions are measured in terms of a particular currency. And our currency is Philippine peso. And what are the components of Philippine peso? Is stability and quantifiability. That can be stability, changes are ignored. Quantifiability, we value them in peso. That is your monetary unit. Fourth concept is your historical cost. Historical cost concept or your cost principle. So when we say historical cost concept or cost principle, this requires that asset should be recorded at cost. So for example, I purchase land for 4 million pesos. The land has a market value of 5 million pesos. Okay, so in historical cost, you will record the asset at cost. So the asset is recorded at cost. So the land, you purchase it at 4 million. Therefore, using historical cost concept, you will record the land at 4 million because you need to record it at cost or historical cost. So that is your historical cost or cost principle. Another concept is your adequate disclosure or full disclosure principle. Full disclosure principle. So under your full disclosure principle, it tells you that all relevant information must be reported. All relevant information must be reported. So this is akin to what we have discussed a while back. We say it is faithfully represented. Okay? So nasabi na natin yan kanina. Items must be faithfully represented. But in the accounting concept, we know this one as your adequate disclosure or full disclosure principle. So for example, in your adequate disclosure, let's say that you have losses, you have a high loss on a transaction. So nagkaroon ka ng net loss dun sa transaction mo. Anong gagawin mo? I-present mo ba siya or hindi? Siyempre, kung ikaw yung owner, ang gagawin mo, ayaw mo siyang i-present kasi makakasira siya dun sa financial statements mo. Baka kalain nila, pangit yung pagkatakbo nung or pangit yung operation ng business mo. However, under adequate disclosure, whether it is beneficial or not beneficial to you or to the business, you need to present it. Okay? So you need to present it whether it is positive or negative as to its effect on the business. Number six, accounting concept, we have the concept of your materiality. Materiality. So this concept talks about the significance of an item on the presentation of financial information. Further, materiality is defined by our standards as the omission, if the omission if the omission of an item could influence the decision making of a user. Okay, so materiality, if the omission of an item could influence the decision making of a user. So take note, significance over the presentation and could influence. So materiality is based on a particular person. There is no specific materiality. So it varies. It varies. Why? So for example, 1 peso is material to another person. And then we have here a billionaire. We have here a billionaire. So may 1 peso. May 1 peso na nawawala. Do you think the 1 peso is material to the billionaire? Not anymore, because 1 peso cannot influence the decision of the billionaire. Okay, so materiality is really variable as to different users. So just take note, when can we say it is material? If ever you omit that, it could influence the decision making. So let's say 1 peso to beggar. Let's say there's a beggar, 1 peso, material. We have here a billionaire, 1 peso. Is it material? No, not material for the billionaire. But the 1 peso could influence the beggar. Therefore, the 1 peso as to the beggar is material. Just to show that materiality varies and it is dependent on the influence on the decision of the user. Okay, so that is materiality. Number 7, we have your accrual basis. Okay. So what is your accrual basis? So accrual basis talks about that if ever we account for transactions when they occur, account for transactions when they occur. Okay, so when we say accrual basis, we have your expense recognition and income recognition. So it is composed of these 2 items, expense recognition and income recognition. Under your expense recognition, under accrual basis expense recognition, expense is recognized when incurred, not when paid. Income recognition, so income is recognized when earned, not when received. So for example, we have here a rent. So your rent is per month. So your rent is per month. So let's say January. And under your contract, you will pay the rent until the 10th day following the month. 10th day following the month. Okay. So you have your January. What is the last day of payment? Last day of payment, that is February 10, diba? So, for example, tapos na yung January. So, ibig sabihin, nagamit mo na yung rent. Nagamit na yung rent. So, kung nagamit na yung rent, it means it is already incurred. Therefore, expense na siya ng January. And sir, paano kung nagbayad lang ako noong February 5? Sabi natin, under accrual basis, you recognize an expense when incurred, not when paid. So kahit bayad siya noong February 5, pero nagamit mo siya on January, kailan natin siya i-record? On January. That is your expense recognition. Same as through your income recognition. Kung kailan tayo kumita, hindi kung kailan natin na-receive yung bayad. Okay? So that is your accrual basis. Number 8, next concept is your consistency concept. Next concept is your consistency concept. So this requires that methods and practices should be applied uniformly. So apply uniformly methods or principles or standards. So in short, you apply uniformly the GAP. Okay, so for example, year 1, you present, you account for your property, plant, and equipment under cost. Therefore, next year, you still apply it under cost. So year 1, you apply at cost. Year 2, for sure, dapat at cost pa rin. Kasi kailangan nga, consistent siya, uniform siya. So you apply uniformly your GAP, consistency. 9, we have your comparability. Comparability. So when we say comparability, you can reach consensus among other users. Reach consensus regarding one information. So for example, on year 1, year 2, nandito, nilagay mo cash and cash equivalents. Okay. Pero nung year 2, ang ginawa mo, pinaghati mo siya. Cash and cash equivalents. Cash and cash, tapos cash equivalents. Okay. So, comparable na ba siya? Ito kasi, isa lang siya, di ba? Cash and cash equivalents. Pwede mo ba siyang i-compare dito? Hindi. Kasi nga, you cannot reach consensus or you cannot compare the items kasi magkaiba na siya. Okay. So, we call this one as your intra-comparability. Intra-comparability. So when we say intra-comparability, it is comparability within the enterprise. How about if ever we have here McDo, we compare it to Jollibee. Okay, McDo and Jollibee, we call this one as your intercomparability. Intercomparability. So it is comparability outside the enterprise. So let's say we are McDo, we try to compare our performance to Jollibee, intercomparability. We compare with other entities or external parties. Okay, so we just need to reach consensus as to one item so that we can compare it. If ever walang consistency, you cannot compare it, of course. Number 10, we also have your going concern. Going concern. So when we say going concern, business will operate in the near future, or the business will continue in operation. Okay. The business will continue in operation in the foreseeable future. Sir, ano yung foreseeable future? Pagka ba tingin ko magko-continue pa rin yung business ko within 3 months, going concern ako? Or within 6 months, going concern ako? Under our standards, auditing, under auditing standards, we can say that the entity is undergoing concern. The entity is undergoing concern if ever you can still foresee that the entity can operate for at least 1 annual period. 1 annual period. So for example, December 31, 2020. This is your annual period. Are you still going concern? If ever you can see that the business will still operate until December 31, 2021, then you are undergoing concern. So you will continue the operation in the foreseeable future. Foreseeable future. Next concept, we have your concept of conservatism or prudence. Conservatism or prudence. Okay, so whenever we say conservatism or prudence, these exist if ever there are different alternatives. There are different alternatives. So choose an item which understate the income rather than overstate it. Okay, choose one item on your alternative that will understate the income rather than overstate it. So example, we have your prepayments. Your prepayments has two alternatives. We have either expense method and we also have your asset method. Expense will decrease the income. Asset will increase the asset. So what will understate the income? Expense method. So what alternative will you choose? The expense method rather than the asset method. That is the concept of conservatism or prudence. So if there are different alternatives, choose which understate the income rather than overstate it. So in the recognizing rather than overstating, you understate the income. Concept of conservatism. Next, the concept of objectivity. So what is the concept of objectivity? So all financial transactions must be properly supported, So for example, we have here a business transaction. Before you will record it, there must be an official receipt. So this will support the business transaction. So we can say it is objective, or the recording of our financial transaction is objective if in case it is supported by your other different business documents, such as your official receipt. Objectivity. 13. You also have your matching principle. So under your matching principle, we try to associate the cause and effect. So normally we use this in your revenue and expense recognition. So you recognize expense when the related revenue is recognized. So example, sale of merchandise. So we first recognize the sale. This is the revenue. Next, we also recognize the expense. That is the cost of merchandise. That is the expense. So cost and effect. So the cost is the sale. The effect, you need to record also the expense, which is the cost of merchandise. So matching principle. Lastly, cost-benefit concept. Under your cost-benefit concept, the cost must not exceed benefit. Okay, the cost must not exceed benefit. So if ever you are presenting an information and you think that the cost is greater than the benefit, then do not present it. So you must always weigh things. the benefit must always be greater. But if the cost is greater, then you better not present that or do not divulge into that transaction in case the benefit is lower or lesser than the cost. Okay, so we discussed 14 concepts in your accounting. Okay.